Hello there, dividend investors. It's the Dividend Uncle, and I've got some juicy insights for you today. We all know how rising interest rates have been casting a shadow over the REIT sector, causing share prices to plummet and dividends to wobble. But what if I told you there's a REIT that seems to be dancing to its own tune? That's right, today, I'm introducing you to the unsung hero, Daiwa House Logistics Trust, or DHLU. Mind you, its share price has also taken a hit just like the rest of the sector, which makes one wonder whether DHLU offers a unique opportunity. Why rising interest rates affect REITs. But before we dive into why DHLU is a standout, let's understand the backdrop. The recent surge in interest rates has sent shockwaves through the REITs world, causing their dividend distributions to quiver. As rates rise, so do the costs of servicing debt for these REITs, which can eat into their profitability. This has led to investors getting cold feet, punishing REITs with falling share prices. But here's where DHLU stands out from the crowd: it's not fazed by the rising interest rates. Why, you ask? It's a purely Japanese-based REITs, and Japan has taken a rather unique stance in response to the global trend. While other countries have been jacking up interest rates to combat inflation, Japan, well, they've been embracing inflation with open arms. For years, Japan's economy has been stuck in the doldrums with episodes of negative inflation. To stimulate its economy, Japan's central bank has kept interest rates astonishingly low. And the good news for DHLU is that all of its debt is denominated in Japanese yen, which means it's been enjoying an average interest rate on its debt at a mere 0.99%, significantly lower than the more than 3% most other REITs are grappling with. Even if global interest rates decide to inch upward, DHLU is unfazed because it's fixed 100% of its debt. Bonus positives for DHLU. But that's not all. DHLU comes with 3 extra cherries on top. 1. Logistics in Japan is projected to thrive, and guess what? Japan's economy seems to be turning a corner after years of stagnation. Even legendary investor Warren Buffett has thrown his hat into the Japanese investment ring. Investors are eyeing Japanese real estate while sidestepping real estate in other countries due to interest rate disparities. Plus, DHLU's underlying properties have been performing like a symphony. In the first half of 2023, revenue and net property income soared by 4.8% and 5.2% in Japanese yen terms, with a full house 100% occupancy. 2. Let's not forget about DHLU's impressive sponsor, Daiwa House, one of the biggest real estate players in Japan. They've got the largest stockpile of logistics space in the country, and here's the kicker: DHLU has the first dibs on buying these properties from their sponsor. Now, that's a partnership you can bank on. 3. Due to the REIT sector's recent nosedive, DHLU's share price has taken a 15% tumble this year, making its dividend yield skyrocket to a jaw-dropping 9.6% per annum. It's like a sales season for dividend hunters. Key risk of DHLU. But let's not ignore the elephant in the room. There's one significant risk to DHLU's equation. Its revenue and hence distributions are in Japanese yen. You see, Japan's decision to keep interest rates low while the rest of the world raises them has had a side effect. The Japanese yen has been on a downward slide, shedding about 10% of its value this year alone. This currency fluctuation means that when DHLU converts its Japanese yen revenue into Singapore dollars, it takes a hit on the distribution front. Remember when I mentioned that 1H 2023 revenue and net property income in Japanese yen soared? Well, when translated to Singapore dollars, it actually went down by 4.3% and 6.6%. But hey, it's not all doom and gloom. DHLU, being the savvy player it is, has hedged its income for the remainder of FY 2023, so no more surprises for now. Besides, the positivity doesn't end there. Positive rental reversions may help offset some of the currency volatility. In conclusion, DHLU is undoubtedly an intriguing player in the REITs field, seemingly untouched by the interest rate storms battering its counterparts. While it's not entirely immune to currency fluctuations, it has taken some prudent steps to shield itself. Keep your eye on this one, my fellow dividend seekers, because in these volatile times, a REITs like DHLU might just be the anchor you need in your portfolio. As always, remember that I'm not your financial advisor. Do your homework, consult with the pros, and make your financial decisions wisely. If you found this video informative, don't forget to like, share, and subscribe for more dividend investment insights. Until next time, this is the Dividend Uncle, signing off.